convertible debt is a promissory note, has a maturity, attracts an interest rate, but is convertible, is required to be converted in what's called a qualified financing, which is defined in the term sheet as some number, typically $1 million or $2 million, and that debt, $100,000 or whatever it is, will convert into that Series A when it's done, typically at a discount. So the investor in the convertible instrument is rewarded for him or her taking a risk on that company to the extent of usually 10 to 20%. And we'll talk a little bit about how that discount is articulated. The other elements of convertible debt is that you have to cover what happens if the debt can't be paid back. In other words, options at maturity, and you also have to cover what happens if there's a change of control prior to the debt becoming mature. So we're going to focus, because most of us have some understanding of convertible debt, we're going to focus on a couple of elements of convertible debt and what's going on with 2 or 3 aspects of it. So the first one is how you articulate this discount that I talked about. It's often articulated as a discount to the next round. So if you put in $100,000, you get $120,000 worth of stock. So you'll get the same issuance of the Series A investor, but you'll get more shares. So that's one way to do it. Another way to do it is to issue warrants for that same 20%. And those, in this case, to adequately and effectively communicate that discount, they have to be penny warrants, because if they had an exercise price of above 1 cent, obviously the investor would have to put more money in to convert them. There is quite a bit of commentator action on warrants versus discounts and how to articulate the discount. There's an excellent article in the research source that I've listed on the slide here that argues quite persuasively that warrants are the best way to articulate the discount for a couple of reasons. One, you often have investors come in the Series A if you have a significant discount in your convertible note and put pressure on the original investors and say, you know, your discount's going to be less. Unless you want the money, unless you don't want the money, your discount just went from 20% to 10%. In fact, I've had a situation where my investors in the convertible note were told by the Series A investors, your 25% discount just went away. I think part of that reason was they viewed the original investors in the convertible note as having been a little hoggish on the 25% discount, so they didn't negotiate it halfway down, they negotiated it all the way down. The convertible note holder then has the choice of saying, you know, what am I going to do? Am I going to let the company tank, or am I going to take this money? So it gets difficult. And if you're holding warrants, it's a little bit different because it's hard to take away a security, right? You got this warrant in the drawer, and it's difficult to take it away. It's not as easy to take it away as to negotiate away a percentage. But there's the look in this particular research source. The percentage discount, which results in more shares to the convertible note holder upon the deal, upon a Series A, actually disadvantages the investor, the Series A investor, because that entity is the one that's getting their position diluted. It's not diluting the company, it's diluting the new investor, right? And what's happening is the folks who get that convertible debt are putting in $100,000 and they, like magic, have $120,000 worth of liquidation preference, right? Because they're getting 20% more shares. In the warrant situation, that discount is delayed until the liquidity event, right? Because they're not going to exercise that warrant until a liquidity event happens. So it's not the Series A investors who are being diluted, or the Series B or Series C or Series D investors who are being diluted. It's everybody effectively at the time of the transaction. Chris, you and I talked a little bit about this last night, and you had a little bit to add, I think.
Yeah, exactly. You know, one of the things that you can do partly with the warrants is you know, someone coming in is they could, it's what it convert, you know, does it, the warrants, are they preferred or are they common? So, you know, if they're sitting as a preferred, you could try and say, well, we'll push the warrants, we want them as common warrants. So as an investor coming in looking at, again, what are the hurdles to clear at liquidation, that can make a difference. I absolutely agree with the percentage. It's somebody, you know, market probably 10 to 20%, but probably if say, you know, the average is I see more around 10%. But you're right, it's an instant bump that it converts in. So it can be it's truly dilutive to the new investors coming in right off the bat.
So the one thing that we have seen is that when it's convertible debt with a discount, if you have a strategic investor coming in, so a company, they actually don't typically negotiate the discount. We haven't actually had pushback from them. It has more to do with the venture groups that actually do it.
So now you might say, well, you know, I'm the investor, so I want the best deal I can have there. The element here is that if you want to be protected, you want your discount protected if you're the convertible note holder from serious negotiation by the Series A holder. And the suggestion is, because warrants are actually more amicable for the Series A investor, and because you have a better chance of holding on to them, it's probably a better choice to articulate that discount in the form of warrants. So let's talk about one other item in convertible debt that everybody often wonders about in the term sheet. What happens if the note isn't paid back at maturity, right? There's been no qualified financing. There's been no change of control. What do we do at maturity? And typically, the company obviously doesn't want to pay the money back. That's one of the disadvantages of the convertible note, is that the company actually owes the money, so they don't want to pay the money back. They want another option at maturity, and that there can be a few of those. One that we see is to convert to common stock at a designated price. So the designated price is typically a valuation that the company's not going to like very much, but the rationale for that is you didn't get your qualified financing. I put my money in. My money's now more seriously at risk than it was to begin with, which was pretty seriously at risk. And I want to take probably twice the number of shares, fully diluted equity interest in your company. Another one is to set up actually a provision that says there's not going to be any Series A preferred because there's been no deal, but we're going to create a Series A preferred on standard terms, and that's what you, Mr. Convertible note holder, are going to get in the event that there's no qualified financing. And you know, the term sheet could go on for 15 pages on what that series looks like, but we typically articulate it in standard terms. So the company actually would set up a preferred stock issuance, and that's what the investor would get for their money. It has to be priced at that point, of course, but the beauty of the convertible debt instrument not setting a valuation, which is one of the big advantages of convertible debt, has gone away at that point anyway because the QF hasn't taken place. A third way that I kind of personally like, that I began to see in term sheets about 5 years ago, was setting actual milestones for where the company's at the time the maturity event arises, and doing the conversion based upon different valuations based upon those milestones, right? So you didn't get financed, but you've got $2 million in revenue, so you shouldn't get squeezed down as badly as you would if you hadn't gotten the pilot off the ground by that point. And we actually go through a waterfall, if you will, of various values and what happens at conversion if there's no payback at maturity. Anybody over there? Keep going? Okay. So the final one, before we get to pros and cons, there's not a slide on this, But the final one is the famous or infamous cap. What value does the convertible note holder get his or her conversion at if there's a very high valuation at the time of the conversion or the Series A investment? So caps have been debated significantly in California and here ever since their incursion in about 2012. Where they came from was there were some unicorns in the valley, you know, and people invested in convertible debt, and then the first round was at $150 million valuation, right? So folks who put in $100,000 looked at that and looked at the percentage that they owned of the company and said, oh my God, that's a disaster, right? So some smart lawyer figured, well, what we'll do is when we do the convertible debt instrument, we'll decide at what point the investor in that convertible debt instrument really gets disadvantaged in the Series A round, right? So we'll set some high number that will address the interests of both the company and the investor so that the company doesn't have to, you know, give a lot of shares to somebody at, say, $4 million when it has a valuation of 20, but the investor gets enough protection on the dilution that there's some number that works. Since then, what's happened is, what often happens, the cap has come down and down and down and down to the point where now a lot of commentators are suggesting that we've killed the convertible debt instrument with the cap because effectively what we're doing is valuing the company at the time we issue the convertible debt instrument. So it's a very difficult item, and it's part of the reason that people who argue for safes and KISS's convertible equity suggest that it's a better vehicle than convertible debt because convertible debt is dead. In my own view, if we negotiate the cap as what it's supposed to be, in other words, a prevention against catastrophic dilution to the original investor and fair to the company, then you can end up with something that's reasonable. Anybody? Yeah? Okay. So here, let's talk about pros and cons then of the convertible note. It doesn't require evaluation, which is what everyone is aiming for at the early stage because we don't know what the company's going to be worth. Very reasonably simple to negotiate and less costly. There's 3 or 4 issues that require negotiation, and there's only a note purchase agreement and the note itself and the term sheet negotiation that has to be negotiated. The good downside protection I didn't talk too much about, but typically our convertible note term sheets have a security interest in them. So if the company tanks before the qualified financing, the holders of that note are in a priority position to the common and to everyone else. In fact, to safes and KISSes as well. Because what would happen is, if you've got that security interest, you'll perfect it. You'll file a UCC1, and then you as the convertible debt holder have an interest in the assets of the company. And I've unfortunately done a number of fire sales for companies that didn't make it to their qualified financing, and the folks who get the money, who get the asset, and who are able to sell pretty much what you end up with is IP that you might be able to sell, and the folks who have the convertible debt are in first position to get at least a percentage of their money back because of that security interest.
So we had a situation a couple of years ago where a company client that we represented had raised about $60 million in 4 rounds of preferred. And the last year was an extreme struggle, and the investors basically did convertible debt at that point. And there was substantial liabilities on the company. I mean, it wasn't to a point where we were going to do a bankruptcy action for it, but because they took the security interest in the IP, which was fairly extensive, lots of patents that had been approved around the world, we were able to basically get the investors back whatever cash was actually left in the business, And, after we paid the employees and kind of took care of that. But it wasn't a happy outcome by any means. And honestly, I can tell you, IP, regardless of how valuable one might think it is not. Not when it's on its own. There is no market for that IP. But they were able to get some of their cash back from the debt.
All right, now we're going to have a little fun and watch a video. This is a video produced by TechCrunch that held an event called Sophisticated Angel versus VC Smackdown. And what they did was they had teams on both sides representing the sophisticated angels on one side and the VCs on another side on about 7 or 8 issues. And the one we're going to watch is on the issue of convertible debt versus equity as an investment in the company, hopefully.
Happy Friday. Welcome to the last segment of the Smackdown between Dave McClure and David Hornick. I'm not even going to call it the Angel VC, the Angel VC Smackdown anymore. It's the David Smackdown. All right. Today's topic is convertible debt versus equity. I mean, this is just the nerdiest. I've never seen such a nerdy topic drive so much passion in the
This is awesome
blogosphere.
because when I went from being a lawyer to a VC, I thought that all of those lawyering skills were of no value. Now I'm the man.
So
You're in demand
we're going to let
again.
you start this one.
Oh, great.
So
What is the difference?
explain your view and why. Why should we care?
Why do people care?
Yeah.
So there are only 2 things that matter. I mean, here's the short take on it. One is about price, and the other is about control, and that is all that matters, and that's all that people are discussing, right? So equity rounds do 2 things. They set a price, and it's a price at that time, and they set a set of controls around the company: when it can raise money, how it can raise money, who's on the board, all of those things, right? Then on the other end of the spectrum is the uncapped convertible note. That basically is, here is my money. Someday you will raise money, and when you do, I'll get that stock, but I'll get a little bit more of it because that's the sweetener for me coming early, right?
Mm-hmm.
Based on the discount.
So you'd say, oh, I get 30% more when you do a financing. And then what's all the rage is the capped convertible round, which basically says, look, here's your money, go build a company, and when you raise money, then we'll get that stock. But by the way, if you raise money at 10 million pre, I still get it at an 8 million pre. So as a result, you get some more, and it's set at a fixed price. So it's like, I'm not going to let you take money and make a bunch of progress on my back and then get the price to 20 million and I get 30% value on that, right? I'm going to set a price that says, look, you can use that money and you can convert it when time comes, but it's at a price. In that instance, and the uncapped convertible note, there are none of these controls, right? The company continues on without the investors having a board seat or liquidation preference or any of that stuff. It is all punted to the future, right?
So why is this creating so much passion?
Well, so if you talk with folks like Paul Graham, they will
Who started this?
Who started this? Yes.
By saying it had
It's
won.
your
Yeah.
fault, Paul Graham, that we give a shit. It was all about, entrepreneurs have all the power now, and the investors don't have the power. And if the entrepreneur has the power, then they would say, I'm going to punt on this stuff, and I'm going to build a big company, and don't worry about it, right? And then there's this undercurrent of, and by the way, VCs are bad guys, and they only want those things basically to screw you. So you should say, no, I will not be screwed. I want to do a convertible note, and then it'll be done at a price. And that's everything that this fight is about, right?
So is it that much better for entrepreneurs?
No, it depends on who you're taking money from. My view is, don't take money from people you don't trust and like, right? If you trust and like people, then you should be able to come to some agreement about how to move forward with that company, right?
What's your view on this?
I mean, I agree with the don't take money from people you don't trust, but I think, trust in Allah, but yoke your camel anyway. You do need to have
The conversation just got nerdy.
Well, so I mean, it's great that I trust you, Mr. Investor, or it's great that I trust you, Ms. Entrepreneur, but let's put some terms in the relationship that we both understand and agree to. I think from my side, one thing that I think is happening in the super angel category is when super angels or notable angel investors, let's just say it that way, invest in some companies, the value of the company goes up from the perception of other investors because investors that are well known are in the company. It's not as much based on the material progress of the company in terms of product or
Dave McClure
customers.
company
It's a
is
Dave McClure effect, is
50%
what
more
you're saying.
valuable.
So, like, I'm not going to say I'm
You
the
should
big
put- you should
shit
get-
in the valley,
You know
but
what you should
like,
get? You should get like a little
But
Dave
you're
McClure.
saying you're the big shit in the valley.
500 hats, like tag that goes
Well,
on each
What about
website.
little buttons full of
So I
pals?
do hope that my brand does matter and helps people
Mm-hmm.
like establish their value and everything, and we'll see if I can do that or not. But I think, generally speaking, you want the company to increase in value based on their own performance, not based on whether I think it's cool or hot or not, or whether other people think I think it's cool or hot or not. And what I think you see happening, this Ron Conway is probably the best example of it, is used to be that convertible notes were a discount based on time, like how much time it took. And then what happened was, well, as soon as Ron's in, the money goes up, right? So Ron and other people that are notable investors don't want to do uncapped convertible notes. In many cases, they don't want to do convertible notes at all because as soon as they put money in, the value of the company goes up and they end up screwing themselves on the discount to some future number. So I think what happens is some angels, myself, well, super angels, whatever you want to call it, will say, great, I'm happy to use a capped note. We don't know what the price is right now. I hope that you're able to successfully move the value of that up to some amount, but I want to know that I get some limited amount of ownership, right? Or some amount of shares or something based on my value that's not too excessive, right? And I think that's the value in the capped note is that you know that there's some limit, but you're not paying for a large legal cost in doing that. It's a relatively simple structure. You can make it quick and easy for both parties. And so you can get capital into the company quickly and they can start to make progress.
Now, Fred Wilson did a post last week saying that, he thinks convertible notes are horrible. He doesn't want to do them. He's a little bit worried that now that super angels are so behind them, he's going to be forced to do them and he's not happy about it. Is part of this you guys just screwing with VCs more?
Is that what you're up to? Because I would like to know.
No,
Is
because
it creating a wedge issue? Because it's become a wedge issue.
See,
between
this
the
is
two.
what's so interesting to me because, by the way, it used to be, there are a bunch of uncapped notes, and then first round capital said, look, we're going to price rounds. We're going to put money in and we're going to invest at a particular price. Now, I wonder, maybe they're being forced to not do that anymore, whatever, but the reality is a capped round is just a price round, right? It's not. So
it's a
where's the
ceiling.
cap? Where's
It's a
the
ceiling.
Yeah, but it's but the question is, the companies that matter are the ones that are successful.
And so it's
right?
basically a
And
price,
so it's
yeah.
about pricing
Right.
your successful investment. So you say, like, I'm willing to do it. I want to cap it at $6 million pre.
Yeah.
You might as well do an equity investment at $6 million pre. If it goes down,
Well, except that the equity investment costs $50,000 to
but
put
it
together
should.
instead
That's
of.
just
Okay,
just
great. If
historic
you go tell
silliness.
Wilson to change how much they're charging, I'll
How
start
much
throwing
is
price
this? 'Cause you were an
rounds.
attorney. You
Yeah.
just like fees.
No, it's just silly. That stuff is going away. Like the idea that this should
Great.
cost $30,000 to get done. Fine. So don't do that, right?
Right.
That's not the problem. The problem is
Well,
the
I think
question
that is the
really-
problem for people who do priced rounds. Like my average
Maybe
cost
that's one of the
structure
reasons people
is a couple
are-
I
thousand
know it's
bucks.
one of the
this.
reasons people are citing it. It's just.
So
just,
this is one of the places where doing investments at scale actually does make a difference. I can negotiate with lawyers and say, look, I'm going to do 30, 50 deals. I'm not paying more than $2,500 for this financing because it's a simple structure and I want to be quick. And
Financing documents are not value add, right? Here's the deal. No one is getting some strategic value from having better financing documents, etc. So the
Au
documents...
contraire, mon frère.
It's
Absolutely.
Totally, no, I'm saying...
You think there's no strategic advantage in having simple term
No,
sheets
that's
or
not
simple
what I'm saying.
documents?
What I'm saying is...
I thought that's what I heard you
No,
say.
Yeah, you're misinterpreting. What I'm saying is, let's lawyer the shit out of this
It's
so we
not
can
something
get
to
the
pay
right
up
thing.
for.
Like, who
Yeah.
cares? The reality is,
Well,
in an
I do
early
ca-
stage,
I
no,
do
in an
care-
early, I'm agreeing with you, Dave. Shut
Okay, great.
up, and I'll agree with you. In an early stage company, they're basic
Feel the love.
terms. The only things you need to worry about are price and option pool and some
I
control crap.
wish more
Agree
VCs
on it, get it done. Who
I wish more
cares?
VCs thought and acted like you just said, and I wish more VCs lawyers didn't charge through the nose to accomplish
Okay,
those goals.
final word, because I've talked to a lot of entrepreneurs who are first-time entrepreneurs in the last week or so. They're seeing all their heroes of investors, whether they're angels or VCs, sounding off about this issue and saying one's good for entrepreneurs, one's good for entrepreneurs. And, I think people are confused. If you're a first-time entrepreneur reading all this, what is the one thing you need to know?
You want an investor who you trust and who adds value to you however you perceive that, and you want a transaction that proceeds quickly without a lot of cost.
Right.
Wow, we're ending it all on a love fest. Well, I want to thank both of you for, making my afternoon entertaining and waking me up from my post-lunch snooze.
So, interesting conversation. What do we take from that video, other than the fact that maybe David Homick should have remained a lawyer rather than a VC? One of the things that I think is interesting is the point on valuation caps. McClure kind of acted like that they were agreeing, I think, and said, yeah, right, it's a ceiling. But I don't think that's what Homick was saying. I think Homick was saying you've priced around. Once you put a valuation cap in there, you've priced around. And that gets back to a little bit about what I was talking about before, in that the valuation cap as it started was, what McClure thinks it was, a ceiling to kind of protect both sides from the unicorn. And Homick disagreed, of course. But you can see that, that's one of the reasons I put it in here, because that's the dialogue even between some smart guys in the Valley. Any comments from the panel?
Yeah, I absolutely subscribe. If you put enough thought into a valuation cap, if I did an equity investment, what would I price this at? So subliminally, I think there is that going on. We don't typically use convertible notes that much, only in the event that we're using it as more of a bridge instrument. We're bridging to the next point, to maybe help the entrepreneur out. It's like if I 3 months and I'm gonna hit these milestones, it's a decent bump in valuation, to a little fairness in it to help the entrepreneur out. So that's how we view convertible notes. We're not just sticking convertible notes out there to hope that some other investor will come along and take us out as a security.
But it was very specifically to allow us to hit like another milestone, so that the valuation would be a bit different. I do deal a lot with very small startup companies now, and most of them do have some type of convertible debt, or they're trying to get some type of convertible debt. And frankly, I see a lot of confusion on the entrepreneur's standpoint about how to value that debt, what does it mean, what happens upon conversion, and those kind of things. So I know that this is education for the investor, but I can say that the entrepreneurs also need a lot of education on this as well, because I think it's something that frankly they don't quite understand very well.